It's straight to the macro. Suyash Choudhary, head fixed income IDFC, now joins in on the show. Suyash, thanks so much for staying by with us. Let's start off with your assessment of the overall US QE taper. Given that the rupee hasn't seen too much of weakness, the bond yields has also traded rather flat. Do you think that most of this negative news of the taper, if it was, has already been priced in, and that the rupee may react perhaps on political uncertainty and the maturity of the OMC dollar swaps now?
Absolutely. In fact, if you put this in context, even with the taper in place, the absolute stock of liquidity that the Fed is injecting is only going up. It's just that it's going up at a more moderate pace than before, and sequentially maybe the pace gets more moderate, even more so. Also, if you look at the way India and emerging markets have prepared over the last 6 months, and let's take the case of India, bond yields have readjusted, the currency has readjusted, the RBI has built a very large war chest of dollars to intervene if required, and most importantly, we are now staring at a current account deficit which is going to be lower this year by almost $30 billion. So I would think most of the QE adjustment is behind us. Obviously, with every incremental Fed meeting, there will be some jitteriness in the market which is to be expected. Furthermore, political uncertainties, I think market will broadly take in their stride. So I would rather expect, let's say, a 61.5 to a 64 kind of range for the rupee in the near term, barring any shocks which are unforeseen right now.
Suyash, what's your opinion on the growth, from here on? Because ever since this GDP growth number has been on the higher side, people have reworked their GDP estimates even for 1 year forward. Have you done the same, and what's the corridor you're looking at?
You need to break the GDP down into sectors. So where the so-called green shoots are coming from are, one, a better harvest, and therefore the boost to allied activities and to some extent rural consumption, and two, on the export sector. But if you look at most of the domestic services sector, that is still struggling. In fact, the momentum there is down, not up. What one also has to factor in, the government of India is finally in belt tightening mode, and media reports suggest that more than 1 lakh crores of planned spending will not happen versus the budget. So that will also take Q4 services GDP lower. So as of now, we are happy to stick with a 4.5 to 5% centric mark for this year. Next year will depend a lot on some of the investments coming back into stream, basically showing as project takeoffs, which at this juncture one has reason to believe, or one doesn't have reason to believe that it's really happening at a fast pace. So I would look for flattish GDP for next year as well, as of now, maybe a 30 or 40 basis point here and there.
Okay, just a second, Suyash is going to address an Orchid Chemicals. That counter has seen a little bit of news coming in. The promoters have released 17 lakh shares from pledge with IFCI. The counter reacting and up by 3.6%. But Suyash, let's talk about the overall monetary policy and what you made of it. Do you think that perhaps this is the beginning of the end of an unconventional monetary policy, given that the structural bottlenecks persist in the economy, inflation figures have only been soaring high?
Well, yes, the exceptional measures that the RBI had undertaken in mid of July have almost totally been unwound. The one thing that remains are the caps that are there on the various liquidity windows still. What we heard from the governor the other day is those are likely to remain in the near term, pending more comfort, more confidence with respect to the INR. In terms of general direction of monetary policy, we think sometimes the market misinterprets the governor's stance around CPI as being very hawkish policy. So the one change that the new governor has possibly brought is that the communication is more anchored around CPI inflation. That by no means suggests that he is a serial rate hiker. And so basically his stance is that we have to control CPI, but since the economy is weak, there are natural disinflationary forces that are always at work. So if the CPI were to continue to rise, any central banker would have hiked rates. But if not, then I don't think the stance is very different from the earlier RBI regime.
Suyash, what's your opinion on the 10-year yields? Because the last 3 days it has been also coming down. Do you think any event could take it back to 9 plus kind of levels going forward?
In the near term, 9 plus looks difficult. So what has comforted the market immensely over the last couple of days is that the outlier expectations from monetary policy have abated. So if you remember going into the last policy, there were even fears that the governor may do a 50 basis hike on the back of 11 quarter CPI print. Now those expectations have gone away. So most of the market thinks that either the repo rate has peaked here or will peak 25 basis higher. So as of now, there is decent interest to buy. However, an underlying problem remains that banks' participation is more muted given the mark-to-market losses they have suffered over the last 4 to 5 months. So I wouldn't expect 9% anytime soon, but I'm happy to work with a band which is roughly 860 to 885 as of now.
So, Suyash, also you're, going forward, what could be the possible risks or red flags you would want to watch out for? Because, one of the opinion is emerging now that the spending cuts which the government is announcing could also have a detrimental impact on growth going forward. How much weight would you give to that argument?
From a bond perspective, actually, that's bullish news. So if growth suffers further, the space that RBI has to adopt pro-cyclical tightening will be that much lesser. From a currency perspective, it may pose a little bit of headwind. So, like I said, barring agriculture and exports, we are still very concerned for services sector. But from a macro angle, the other two concerns clearly would be that inflation remains stickier than what we expect. So over December, vegetable prices are falling. But if the extent of fall is not enough, or if there are other contributory factors that emerge in the next few readings, so that's a macro risk. And the other clearly is the currency, which looks to be stable, but if an unforeseen shock were to happen, then obviously that would pose as a macro risk. But at this juncture, I would think we are much more stable than we were 3 to 4 months back, and there is every reason to be more optimistic.